Hi, I'm Rayanne Catron with Remax Metro Realty. With me today is Brenda Leach, a mortgage officer with Republic Mortgage. I chose Brenda to assist me in this webinar because of the dedication I see she has with her clients and the determination she has with her first-time homebuyers to make sure they get the proper foundation of a lifetime of successful home ownership. We will be your guides in this webinar. Lenders and real estate brokers work hand in hand during your home buying experience to educate, guide, and protect you. Our goal is to acquaint you with the key tools and steps toward owning a home responsibly. I know you get excited just thinking about owning a home. You're watching HGTV, you're picking out colors, you're looking at furniture. You're deciding on who are you going to have over for a party. Yet we know it can be a daunting, windy road when you think about the process. Our job is to take the speed bumps out, straighten the windy road. Your foundation for this will be education and sensible steps that we lay out for you. And you can take just one step at a time. Why do Brenda and I do this work? Because we love handing keys to first-time homeowners, such as Billy and Eni here, relaxing for the first time in their new home. How easy is this webinar? It is really easy. Just grab a cup of coffee or a glass of wine, a notepad and a pen. You can do it at noon or at midnight. And it'll take just about an hour. Plus, the segment topics are to your left so that you can go back and review a particular topic. Questions? Simply email or give us a call. Our contact information is on the last slide. Are you ready? Let's go! Are you ready to be a homeowner? Do the pros outweigh the cons for you right now? Here's a simple chart that has some points for you to consider. When you own a home, it creates stability. However, continuing to rent gives you mobility and flexibility. Owning a home, you're responsible for the repairs and maintenance and budgeting to make sure you have the funds. Where when you rent, usually there's no repairs and the fees are included in your rent. Owning a home can be in a more private and quiet area, where continuing to rent, you may be in a denser apartment situation. Owning a home, you can have static payments for 30 years, where continuing to rent, you will have rent increases and you cannot do anything about that. Owning a home, you build your own equity. Continuing to rent, you build somebody else's equity. I was talking to a new homeowner the other day about what it feels like right now. She had just purchased her first home as a single woman about 6 months ago. What was so amazing to her is the feeling of satisfaction she has, and that it's an outward side of the career and financial choices and sacrifices she has made. And yet, it's not right for everyone right now. Which is right for you? Purchasing a home is easier than you think. If you feel that home ownership might be for you, you owe it to yourself and your family to meet with a lender to see what programs are available for your particular situation. There is no charge. It's free information. You might be surprised. I'm often surprised. Brenda will amaze you here shortly. There are so many down payment assistance dollars that go unused. There are credit repair services that can change your credit scores. Did you know child support and spousal maintenance can count as income? That having a family member with an ADA diagnosed disability, even ADHD, opens up special home purchasing options. No scenario is silly, really. Trust me on this one. And if it won't work now, then you will know how to build for the future. This knowledge will be power for you. Brenda, would you give them some tips now and keys on the lending process?
You bet. A good lender is not simply a source of funds, but they're also a partner in your future success as a homeowner. Helping you understand the steps of home ownership is a small part of a much bigger picture. If you don't set a goal, you're never going to achieve one. So you have to start somewhere, right? So getting to know and understand what lenders are looking for is the first step, and an important one. Lenders like to see at least 2 years in the same line of work to show stability. Now, many college graduates think that it's going to be difficult for them to purchase a home for qualification, even though they have the income to do it. But did you know that your education, your degree program actually counts towards those 2 years of experience in the same line of work that the lenders like to see? And as Rayanne mentioned, if you receive income from outside sources, such as child support or a second job or alimony, make sure you mention it to your lender. That counts also. Understanding how you spend your money, that's a really important part of it as well, and we're going to talk about that in detail. Those lattes at $5, $6 a pop really add up. Then evaluating your current credit standing to see if it's the best that it can be, and also to make sure that it's accurate. Everyone makes mistakes, including the credit bureaus. A good lender is going to help you fix that. So let's just get started. During the pre-approval process, the lender is going to be able to identify if you're in a buying position by performing some preliminary analysis. Using the income documentation, looking at your assets, such as your bank statements, and reviewing your credit by pulling a report, a preliminary approval can be provided right on the spot before you've ever gone shopping or even contacted a realtor. This will help you stay on budget and be efficient, only viewing homes that you can actually afford. So why is it so important to get pre-approved for a loan? Because the realtors, especially the listing agents, they know that you've gone through the necessary steps and you're serious. It also tells them how much the bank is willing to lend and how much you're comfortable spending. And it gives them the opportunity, the lender that is, to give you a pre-approval letter. Also expected is a good faith estimate and a truth in lending disclosure. That basically tells you what the true cost of the loan is, so you go in with your eyes open. So the lender is primarily looking for a borrower who's really in a position to repay that loan. Do you have sufficient income? As I said, lenders can use income from multiple sources, but those sources have to have a guarantee of continuance for at least 3 years or more. Things like child support or alimony can often be used, but if that child's 18, unless there's something in writing, that's going to be a challenge. Other sources can be full or part-time employment, your dividend or trust income, or even retirement earnings. Things that generally can't be used are things like student aid grants or GI Bill proceeds. Those don't have a guarantee. Your debt to income ratio, in simple terms, simply means the percentage of your income that's being consumed by your debt. We'll talk more about this in a future slide. Having good credit is very important, but sometimes having no credit is much better than having bad credit. What I mean by that is, if the only credit you've ever established hasn't been positive, then it would be better that you are debt-free and have no credit, and we can help you identify sources that are maybe things that don't pop into your mind automatically, that we can create an alternative credit score. Things like your cell phone bill or your car insurance. If you have something negative in your past, explain those circumstances to your lender. Don't think that it makes you unable to buy a home. Often extenuating circumstances enables isolated events to be forgiven. In addition, many lenders have tools to help you repair your credit in your journey towards homeownership. Savings are not always required, but often make your lending risk appear much more favorable to the lender. For instance, if you've been able to save money each month, the lender will not be as concerned if your home loan payment is more expensive than your rent. However, if your payment is going up, your rent was quite low, and you have no savings to show for your income stream, they're going to have some concern with something called payment shock. the difference between your rent and your actual monthly house payment. When you meet with your lender for the first time, they're going to require you to bring some application documentation with you. General rule of thumb is 1, 2, and 2. A month of pay stubs. Hopefully those will show year-to-date income. And then any other sources of income that you may have, such as retirement or Social Security. Your bank and retirement statements, all the pages. So if they're sequentially numbered 1 of 5, even if 2 and 4 are blank, have to bring those with you so that we can account for all the pages. And 2 years of tax returns, including your W-2s, or if you're a commission or self-employed person, 1099s. Lastly, if you have any unconventional sources of income, such as child support, alimony, then you'll want to bring those documentations with you as well. Those court orders will show how long that is guaranteed to continue. Remember, we have that 3-year rule. And then lastly, if you have a bankruptcy in your past, sometimes what happens is the credit report actually has debt that was part of the bankruptcy that should no longer show. Bring a copy of that documentation of the bankruptcy. Your lender will be able to help you clean up your credit report so that it appears more accurate. One quick note, government loans such as VA or FHA, first-time homebuyer programs, they may require additional documentation such as an extra year of tax returns. When meeting with your lender, a couple of things are going to occur. Having provided your income documentation and allowing them to pull your credit, they're going to help you compute what your total debt ratio is. Your debt ratio is going to basically be the before and after picture of buying the house. The monthly house payment, or PITI, the minimum payments on all of your revolving debt, such as credit cards, any car payment, student loan payments, even if they're deferred, and then things like child support or tax liens. Now remember, lenders are using your gross income numbers. That means your income before taxes. It's always a good idea to budget using your net income, however. That's truly how much you have to spend. PITI, what the heck is that? Well, principal is simply the amount of the loan that you're purchasing. If you buy a house for $200,000, you put $20,000 down. The principal portion of your loan is $180,000, the remaining balance. The interest portion of your monthly payment is actually the interest that accrues on your mortgage over the life of the loan. Taxes and insurance are pretty self-explanatory, taxes being assessed by the county in which you're purchasing, and insurance such as your homeowner's insurance, which is the replacement value of the home. Now, most lenders will give you the option of escrowing or saving your taxes and insurance in an escrow account at their location and have it be built into your mortgage payment each month. It's always recommended to allow your mortgage to save them for you so that you don't have a large lump sum, especially if you're a first-time home buyer. The 4 C's of credit is simply a reminder of what key elements a lender looks for when evaluating the borrower. Put yourself in their shoes. If you had $100,000 and someone wanted to borrow it, what kind of requirements might you have to make sure that you're going to get repaid? Capital, certainly. The cash required for your down payment and closing costs. Are you going to have any skin in the game? If you're going zero down, do you really have any risk involved at your end of the table? Capacity. Based on your income and the debt, do you have the ability to repay that loan? Character or credit. Do you repay the debt that you already have? Sometimes that best predictor of past performance or future performance is past performance. Collateral. Will the lender be fully protected if you fail to repay the loan? How much cash you need to close on any purchase transaction varies from home to home. Closing costs are simply the expenses related to acquiring the home, and this includes many things such as third-party charges, as title and escrow, or an appraisal to make sure that the value of the home is really what you're paying for. Inspections, such as the roof or pest. Closing costs, such as title and escrow charges. can vary based on the loan amount and based on the price of the home that you're purchasing. Many of the loan programs actually require reserves or for you to have some cash holdings for rainy day funds and earnest money, which Rayanne will talk to you about. So after determining your housing history for the last 2 years, verifying your rent as an example, your employment and asset information, your lender will pull credit and determine how much you can borrow. They will walk you through each phase, closing the loan, which is simply transferring ownership to you, and then when your first payment is due. If you ever find yourself in a financial pickle, communication is so important to prevent late payments or foreclosure. Your lender will determine whether or not you qualify for some of those special programs that Rayanne alluded to just a little while ago. And they'll walk you through each step of the loan process, all the way down to the point in which you sign and get your keys. Down payment assistance programs have their own set of rules, and it's important to determine your qualifications if this is a need that you have. Qualified lenders are well-rounded. In addition to knowing the basics of the common loan programs, they'll also know how to utilize the many different down payment and closing cost programs for which you may be qualified. Most of these are limited to first-time home buyers, but what most people don't understand is by definition, a first-time home buyer is simply someone who hasn't owned a home in the past 3 years. So if you owned a home 4 or 5 years ago, guess what? You get to be a first-timer all over again, and you get to qualify for some of these programs. For more information pertaining to down payment assistance, we'll be providing you our contact information. Government loans are loans such as VA and FHA, which have their own set of parameters. Zero down loans, such as VA loans, allow you to borrow up to $417,000, and they include both fixed rate and adjustable rate loans. In order to use a VA loan, you must be a qualified veteran and having served for a period of time in the armed forces. An FHA loan, which has much more flexible qualifying guidelines than your standard conventional loans, only require 3.5% down. Did you know that loan amounts in Pierce County can go all the way up to $567,000 for an FHA loan and still only require 3.5% down? Conventional loans are loans for people with very strong credit. They have more strict underwriting criteria than a typical government loan. They also require a down payment, typically of 10%, but sometimes for very well-qualified borrowers, 5% down. Down payments must be higher than that, significantly higher, 15 to 20% if your loan amount is over $417,000. We call those jumbos. The down payment, however, can be a gift as long as it's from an immediate family member, and it also can come from a down payment assistance program. Just a footnote, whereas the normal government program only requires a 620 or a 640 FICO score, on average conventional loans require about a 660 credit score. Your lender can walk you through this process and help you identify where you are and what loan programs you qualify for. Budgeting. Budgeting is such a critical part of the purchase process. Nutritionists often recommend a food journal to gain a better understanding of where your calories are being spent. Well, a good lender is going to recommend to you a spending journal. Those lattes, sodas, convenience stores, bottled waters, trips through the drive-thru at McDonald's when you're really not that hungry, they all add up. Demonstrating an ability to save money versus spending every bit of your income is such a great indicator of financial stability. As I said earlier, it's seen as a predictor of your likelihood to repay the loan in the eyes of the lender. So how much can you really afford? As we talked about, most lenders qualify you based on your gross income, but for budgeting, let's look at your take-home pay to make sure you can comfortably afford all of your obligations, and in addition to the added payment of a home. Your housing expense to income ratio includes principal and interest, hazard insurance, which is just a fancy word for homeowners, your real estate taxes, and potentially mortgage insurance. Mortgage insurance is simply an additional insurance that's required when you have very low equity in the home. Other considerations when you're thinking about what kind of property and where you want to purchase. Does it have a homeowner association, such as a condo? That can really dip into your buying power because a condo association dues can be $300 to $400 a month. Subordinate financing is a fancy word for a second loan. Some of the down payment assistance programs do require you to pay that money back. That would be an example of subordinate financing. We add all those things together, we divide it by your monthly gross income, and that percentage point becomes your front-end payment ratio. Mistakes happen. We get that. A good lender can often facilitate the correction of any errors that might occur on your credit report. Credit scores can be impacted by so many variables. Things like late payments or circumstances such as medical emergencies or job loss often create challenges to repay the debt. Work with a lender and explain your situation. Many times exceptions can be made for extenuating circumstances, especially if those circumstances were beyond your control or if they were an isolated event. When a lender is looking at your credit, they're looking at what have you done lately, not necessarily what did you do when you were a young college student 10 years ago or 5 years ago. So the 24 months prior to getting pre-qualified for a home loan, those are very, very important for evaluation. All right, we've all heard it. Banks aren't lending. There's all this money and no one can have it. Absolutely false. The market plunge in housing was a direct result of lax underwriting and inflated appreciation rates among home values. So the big difference between then and now is that today all the income gets verified. Credit score requirements, which were once 580, which incidentally are primarily for those people who are late pretty consistently on all their debt, are now 620 and 660 minimum. In addition, lenders are required to be licensed so that they can be held accountable personally and as an organization in case that they do not follow all the proper procedures. Safeguards for preventing the mortgage collapse absolutely resulted in the tighter guidelines. However, it's important for you to realize that most of the guidelines that have been put into place now are to protect you from inflated home values, and to protect you from being put into a mortgage in which you cannot afford it at a later date. Our goal is to help you be successful as a homeowner. For more information, you're always welcome to visit www.hud.gov. That stands for Housing and Urban Development, and that's the governmental agency that has additional resources on how to be successful. Rayanne's going to now walk you through the very exciting process of purchasing a home.
The role of a real estate broker. Why use a real estate broker? You could just go to open houses on your own, call listing agents on your own, call FSBOs on your own from Craigslist, then use an attorney to write an offer. You've watched HGTV. Or use Uncle Earl. He has a dusty license on the wall, but it's not his true profession. All this might be fine if you are an experienced homebuyer. However, there is no cost to you to use a full-time real estate professional. So why not have a strong advocate on your side? What do we do? Why is this person so important? What we do is we listen to you. What do you want? What do you need? How is that different? I watch for how you are in a home we tour, your unspoken communication. Are you comfortable? Do you relax? Do you say, this home feels like us? I listen to your concerns and your frustrations. I keep you off the edge. A real estate broker also educates. I continually educate you along the way. This starts when we first meet. I want you to be very informed and knowledgeable. We'll take it one step at a time. Remember, knowledge is power and the key to your success. A real estate broker is a guide. By helping you keep your priorities in line, reviewing your needs and wants as you get closer to a decision. I ask the tough questions. Will this home really meet your needs? How about the neighborhood, the commute? Is the mortgage payment going to be comfortable? Or is the stretch worth it? Will the features you thought you needed that are missing be outweighed by the home in general? A real estate broker protects. It's often to protect you from yourself and to not buy a home just because it's bright and shiny, but because it'll truly meet your needs. It's important to fully understand the purchase and sale contract and to understand the negotiation process. And I protect you by helping you see the unseen and what is coming up down the road. I see a real estate broker kind of like an event planner, a wedding planner. I look at the big picture and the entire process. I make sure the little details are perfect. And I steer you clear of as many potholes and hurdles in the path as possible. My goal is to keep you calm. Each purchase has its own unique challenges, some so small you won't even notice, and some large enough they need careful maneuvering. My job is to be your guide when tough decisions need to be made, all the while keeping you focused on the end result, handing you the keys to your new home, as I am handing Josh the keys to his first home. This is where it gets fun. The features of your new home. What do you want? What do you see the needs of your family? I've created a special sheet for you to complete that will be helpful in setting your priorities. Simply contact me and that planning tool is yours. What about size? Not only of the home, but of the living spaces, the kitchen, the family spaces. What size bedrooms do you need? How many bedrooms do you need? And do you need them all on one floor? How important is a full bath off the master? What about garages and outbuildings? Are you a serious car buff? How many garage bays do you need? What about a man cave? We can laugh, but sometimes this is really important. Do you have horses or cows? Do you want to garden? Do you have a dog that needs a fenced yard? And speaking of the yard, how big of a yard do you really want to mow and to keep up? Will you need a riding lawnmower or simply a push mower? Will the kids really be mowing the lawn? The condition of the home is also a critical question. Be very mindful of the kind of project you can take on. What are your skills? How much time do you have? Can your family live there as the work is done? Or is it simply changing out the carpet and painting? A weekend job before you move in, and that's worth it because you love that house. And the neighborhood, more on that a little later. Suffice to say for now that you can get more for your money in some neighborhoods than others. So what's more important to you, features or location? The types of home. There are several types of homes. A single-family residence is usually the standalone traditional home on its own lot. You own the house and the property surrounding it. You are fully responsible for the upkeep and repairs, and you can decorate and update and garden and live in it as you'd like. These homes can be in areas that have a homeowners association with homeowner dues. Even though you own the home and land, these associations have some governing rules and regulations, possibly limiting that freedom. In return, these homeowner associations serve to offer balance and set a standard to the community. Townhomes are technically single-family residents. However, they are usually physically attached to another single-family residence, like row houses in San Francisco. Here you own the house and the land under you. But out of necessity, they usually do come with the homeowners association and dues. That's because you're all tied together and you need to have rules governing how are you going to upkeep the building and the grounds. Condos or condominiums are often purchased because they're easier to maintain for you. The benefit is there is a management association that takes care of general maintenance and repairs of the building. No more climbing on ladders to clean the gutters for you. However, you are responsible for what's happening inside your particular unit. And be mindful, the strength and financial foundation of the homeowners association is of utmost importance. Know before you buy. Manufactured homes are homes built off-site that have wheels and are driven and assembled on a piece of property. They are often very well built and have many lovely options. They can be in communities of other manufactured homes, again with homeowners associations and dues, or they can be placed singly on a piece of property. Oftentimes, it's a better value than a traditionally built home. Who is the seller? Why is this important? The type of seller will dictate the ease of the purchase, how many repairs on the home they will or will not fix, how long the process will take to close, and what the process may cost you. Traditional sellers are people who have either enough equity to close the sale or enough in the bank to write a check at closing to make up the difference. There are no banks or government departments involved. Sometimes this includes estates or LLCs, people that have flipped a home. Short sales are homes that the owner owes more than the home can be sold for, and they do not have the cash to add. In these situations, each bank they have a loan with becomes a decision maker. Once the sellers and you have an agreement, that agreement goes to each bank. The seller needs to be very motivated, ready to constantly give new information to the bank, and stay engaged in what can be a lengthy process. These homes are usually sold as is, since the seller doesn't have any money to put into the home. On the other hand, some short sales are easier than others and can be better predicted from the outset, and there are some good values to be had. Bank-owned or REO properties are owned by the bank. The bank has a department usually dedicated to this process. Once you make an agreement, the bank will have their own set of documents and their own way of doing business. However, here it is much more of a set agreement than a short sale. It's really more like a traditional seller. Here the purchase and sale agreement sticks and can be counted on once an agreement is made. Most of the time, however, no repairs will be made to the home, as they are sold as is. The time frame depends on the particular bank, but it can be a normal period of time. Bankruptcy sales are homes that the sellers have filed for bankruptcy, and this house is a part of that agreement. There are several layers of decision makers here, and it's important to fully know the process. Understand there are extra fees involved here, often thousands of dollars that go above and beyond the purchase price. As you can see, after talking about these options with your real estate broker, you may choose to eliminate one or more of these options as you begin to look for homes. It may not work for you, and they may not work for your timeline. Finding the right home. Let's go shopping. By now you should be set. You have your list of features in a home you'd like to find. You know a little bit about the different kinds of homes and the types of sellers that are available. And you've chosen a real estate broker to represent you. It looks like a lot of homes out there for sale, and that's true. However, once you've determined your needs and wants, there are really very few out there that will suit you. I think finding the right home for a client is like a treasure hunt. We start out with what you want and begin collecting additional clues along the way, adjusting your search accordingly. This approach just makes it more fun, I think, and often takes some of the frustrations out of the home search. As with treasure hunts, we really don't know what the treasure looks like or where it's going to be until all the clues lead us there. The same is true of your home. You don't really know what it's going to look like or where it is right now, not until we have followed the clues. And trust me, when you reach the treasure, you will know it. Your real estate broker will blend your list of features, desired communities, and budgets together to create a tour of homes for you. And also, there's plenty of websites for you to view and begin your search, and I'm sure you've already been to them. I love seeing what catches my buyer's eyes. That's another piece of information I use when crafting a tour of homes. Remember to stay flexible in what will work for you, and above all, maintain your sense of humor. My goal is to match your dreams, desires, and financial abilities with the best home possible, to follow the clues until the treasure, your new home, is discovered. You've heard it before. location, location, location. By this point, you've prioritized your needs with your budget and decided on what community you think will work the best for you. And you may have selected a home. Now let's examine that area. Let's make sure that the home and the community are an all-around good match for you. You must feel comfortable in the area you choose to live in. Take the time to look around. Consider some of these questions. Where do your friends and family live? Are they close enough? Are they far enough? What are your free time activities, and are you close to them? What about churches, participatory sports, walking trails, horse trails, service organizations you participate in? Check out the commute time, the highway convenience, the public transportation, if those are concerns for you. Some communities have a strong sense of neighborhood. Some communities have neighborhood watches for safety. Do you or will you have children? Where are the schools and the playgrounds? Go back to the area. Go during different times of the day and night and take this time. Go talk to the neighbors. Yes, go knock on their doors. You'd be surprised what you'll discover. Remember, purchasing is about compromise. Recently I had some clients shown here with the keys to their new home that made a different community choice than they originally thought. They had wanted to be fairly near their employment, yet they had a list of important features they wanted in a home. It turned out the best match in a home for them was a longer commute, and they were okay with that. And a bonus for them is that they have a full-on view of Mount Rainier from their bedroom window every morning. The commute compromise worked for them. You've found the right house? Now what? Well, it's time to take a deep breath. I like to sit down in that home with my clients and review their wants and needs and look at what there is there and what is missing. Once you've determined, yes, this is the house for you, then simply have your lender forward a pre-approval letter so it can be included in the offer package we will send to the seller. And when you meet to actually write an offer, bring your checkbook. You will want to write a check for earnest money. Like Brenda said, the seller is going to want to see a sum of money that shows that you are earnest in purchasing their home. Now, set aside an hour or so to get the offer written and the contract fully explained to you. Let's talk a little bit about the market. Before we craft an offer and talk about the items to be negotiated, let's talk about the real estate market. This will affect the kind of offer you write. Here again, knowledge is power. Remember back in the day when houses were flying off the shelf faster than offers could be written and it was a seller's market? And for the most part, indeed it was. They could ask and receive what and more than they wanted. They didn't have to compromise on price or repair or anything. They were in the driver's seat. Now we talk a lot about it's a buyer's market, that there are so many homes for sale that the buyers have vice grips on the sellers. If the seller wants to sell, well, they better take what the buyer is offering, and they better fix what the buyer wants after the inspection. Then there's the balanced market, where there's an appropriate give and take, and all walk away from negotiations fairly content. You'll be very surprised to know that they all exist today. The media gives blanket statements about the market. And yes, overall, it can be a buyer's market or a seller's market. However, there are pockets of each market in your area. It may have to do with the price point, the style of home, or the particular neighborhood. It is important to know the statistics for the particular neighborhood and price point you want to purchase in. And those statistics presented with your offer will strengthen your chance of the seller accepting the offer you have written. You will be very surprised. That knowledge is power. The bottom line, however, is this home for you? Are you buying a home that meets the criteria for your family? Or are you fishing for a steal? The purchase and sale contract. First of all, please understand this is a legally binding contract. You must be willing to do what you put down that you say you're going to do on the form. You must be truthful. You must understand the risks if you don't follow through. The price is indeed the biggest factor in negotiations. However, there are other items such as appliances, earnest money, move-in dates that all need to be agreed upon. The purchase price is often balanced with any request for the seller to pay a part or all of your closing costs. That's what we call seller's concessions. The financing contingency is important. If you can't get the loan that you are approved for, that you think you are approved for, then you're going to need to get out of the contract. Often, you will get your earnest money back. The inspection contingency, we'll talk about that on the next slide. If the contract you present to the seller initially is not agreeable with them, they will no doubt make some changes, a counteroffer, and give it back to you. You can go back and forth as long as the two parties stay interested. However, what's important to know is that the home stays on the market until both parties agree on all points. Someone can come with a more agreeable offer in the middle of your negotiations and purchase the house out from under you. So don't dink around needlessly. These are just a few of the negotiable items. Once the contract has been agreed upon, the inspection will be the next item to be negotiated. Now that all parties have agreed on the contract, we're going to proceed to the home inspection. The sooner the better. You will want a licensed home inspector. They are also licensed to do a pest inspection in Washington State. Depending on the inspector and the home to be inspected, it'll roughly take 2 or 3 hours, and the cost will vary, but oftentimes you're looking at plus or minus $350. And should you be there? By all means. This is your home, and you're paying for this inspection. These professionals can give you tips and tell you a lot about your home, more than you will find out just reading a report. What do they look for? They look at the systems of the home, inside the electrical panel to make sure Cousin Joe didn't cob something together. Check for leaks and rotten flooring. Go under the house and look for leaks, rot, pests, anything not to code. They go up on the roof. They go into the attic. They go around the yard. These folks know codes and know safety. And together you will go over the report and determine what are safety and health concerns that are important for you to ask the seller to repair. And what items really would be better if you fixed to your own standard once you own the home that you will not ask them to do. Many homes are sold as is, as the short sales and bank-owned homes. However, it's still important for you to have a home inspection so that you are confident that the home you're purchasing is as solid as it seems. And oftentimes, however, there are safety issues and the banks may fix them, or you may need to add special funds to your loan to get them taken care of as soon after your ownership. So even though the listing may say, sold as is, don't assume that they won't fix serious problems. If you don't ask, they won't say yes. It's always worth a shot. Now, Brenda, would you talk to us a little bit about what's going on now with the loan process?
You bet. So we've written a contract. You are pre-approved for your home loan, and all the information pertaining to the negotiation and the contract terms have been given to me. Well, and now you're going to enter what is called the processing phase. I cannot say this enough. Please, please, please don't go buy your dream boat. Don't go buy your perfect car. Don't go and get a new credit card because you're going to get 10% off at Target. During the processing phase, it is absolutely critical that nothing impact your credit. Behind the scenes, no news really is good news. We are setting up your title insurance, setting up the escrow phase. We are ordering the appraisal. The appraisal is such an important piece of this process. Don't be surprised if your lender asks you upfront for a credit card number or a personal check to secure the appraisal. The appraisal process is necessary for any home loan, and that appraiser must be paid by someone. So whether you continue with this loan or not, you own that appraiser. So therefore, the lender may very well ask for a deposit of this third-party fee. They may also ask for a credit deposit, and they will hold that. And if the seller is paying the closing costs, then you will have refund of any upfront money that you may have put towards the transaction. Many borrowers don't understand the underwriting process, so I'm going to try and make it very simple for you. The underwriter is simply making sure that your loan officer did everything correctly, making sure that you met all the parameters of the loan program, and making sure that any questions that arise during the lending process get answered. So don't be surprised if your underwriter comes back with a question or two asking for an explanation. Do you remember when I talked to you about making sure that any unusual circumstances in particularly your credit past, are explainable? That's so that we can answer those questions before they're asked. Just because the underwriter asks more questions later doesn't mean that it's not okay or that something's wrong. Just simply means we're dotting I's and crossing T's. And the last and final exciting phase is once that final underwriting step occurs, loan documents get drawn and we wire them or email them to the escrow company in preparation for your signing. This is nervous for the home buyer, but also, I think, one of the most exciting phases. Rayanne?
Now let's talk about the final keys to home ownership. Title insurance. You will be introduced to title insurance while you're writing your contract. This is like any insurance. It protects you. It is not optional. You will be buying title insurance for your mortgage company. However, the seller will be buying title insurance for you to protect that you will always own the property should some problems come up. Escrow is a service that's a neutral third party. They put all the pieces together. They do the math, they pay the bills, and they assist in the preparation and signing of the documents. They work closely with the title company, making sure everything is clear and ready to go on that end. You and the seller actually divide the escrow fee. Unless you have an FHA or a VA loan, there may be some adjustments to that. Once your lender has gone over your file with a very fine-tooth comb and are 100% certain that everything is in order, they will order what we keep calling the docs, or the loan documents, to be produced. At this time, the escrow company will then determine exactly how much money you need to bring with you to purchase the home. So when they give you a call and schedule the time to come in to sign all of the documents, be sure to bring the amount of money with you or to have information on wiring the funds. And plan on spending about an hour. And usually this will happen a day or two ahead of the actual closing of the home or the recording. If one of the new homeowners will not be in the area to sign these documents, they can use a power of attorney. This enables someone to sign on their behalf, but it needs to be determined ahead of time. There is a difference between, like I was just saying, the signing and the recording. Once you sign the documents, depending upon the lender, they will be looked at one more time. And usually they are a day or two apart. Once a real estate broker has word that your documents have been recorded by the county, that they have been stamped and you now own the home, then you can receive your keys. You have gone through a lengthy, often challenging journey, and now let the celebration begin. Congratulations! What can you do today? If the possibility of owning your home sounds exciting, you owe it to yourself to now meet with a lender if you haven't already done so. There are so many options and choices, like I said, and like you heard Brenda talk about, that allow folks to purchase a home. Many are surprised they qualify. And remember, it doesn't cost you anything to find out. If you've been to a lender, then now's the time to meet with your real estate broker and go shopping. This is an excellent time to purchase. Do you want to know more about these topics? This webinar was designed to give you an introduction into the process of home ownership. Brenda and I are instructors for the Washington State Housing and Finance Commission. They offer a 5-hour certificate course. This course goes into much more detail with hands-on materials. Should you qualify for any state bonds, down payment assistance, or USDA funds, you will be required to take this course. Why not take it now and use that information? Here's the contact information for Brenda and myself. Feel free to contact either one of us with any questions that come up for you. We are not going to bug you. We simply want you to have the information you want and need to make good choices for yourself. Even though Brenda and I work well together and make exciting opportunities happen for people, we understand that you may have a lender or a real estate broker you are already familiar with and comfortable with. However, if you choose to work with one or both of us because you are comfortable, that's fantastic. We sincerely hope this time with us was well worth it for you. Our best to you going forward in the home buying process to secure the keys to your first home.